us right now from the Chicago Board Options Exchange, Doug Prskalo of Blue Capital Group. He actively trades S&P 500 index options. Also back with us, Linn Ellis, Managing Director at Linn Group and Chief Investment Officer at Strategic Financial Group. He says an uptick in interest rates would help to spur growth. Lincoln, I know you're a bear, so what do you make of today's rally here?
Yeah, you know, it's a bit of the end of the summer, very thin. Markets have been straight up and straight down for some time. And it's interesting, we were talking about this in a meeting yesterday, that sentiment had become so bearish that we almost expected a pop like this, and it just was this small piece of incremental data in the ISM today that upticked. I also think that there was an expectation that that ADP number, in fact, would be much closer to 10,000 than 40,000, which was the consensus. And that, too, actually put a little bit of a spark underneath a very thinly traded market, and that's what's pushed us up to these new high levels, as Dom was pointing out, right up close to that 1080 level at S&P, at quite a key level for both bulls and bears.
Now, Lincoln, it's Dominic here. One thing, let's turn to the bond market, because the last time we spoke to you, you had said that treasuries are in a bubble at this point, and you were expecting a drop in treasury prices. We're kind of seeing some of that action today. Do you expect follow-through? Do you think rates could actually go up from here?
Should I lock in my rate?
Yeah, you should definitely lock in your rate, Matt. But I do think that it's simply a matter, Dom, that Treasury prices on the long end have come so far so fast, and that's really what we were talking about in that comment a couple weeks ago. It does continue to impress us that the 10-year of all of them continues to push lower and lower on that yield, and that does not portend well in the long term for stocks.
Doug, I want to bring you into this conversation. You've been waiting there patiently. We did get a mixed bag of data, but it looks like investors chose to really key on the manufacturing data, not only here in the United States, but out of China. What was the key impetus to you in terms of what really sent stocks higher today?
I think the key thing was the beating the stocks took in August. I mean, the market got, really taken down a lot in August. First day of the month. I'm not saying September is going to be a great month. It's a good start, but such low volume in the market right now. I'm not sure. I'm not totally buying it. Not trying to be pessimistic. I'm not totally buying it. Everyone watched the market rally today, kind of stood back. Obviously, we're all waiting for the employment numbers on Friday.
Hey, let me ask you, Doug. I mean, we were talking about during the commercial break, volume. It's pretty lackluster, about average today at 8.3 billion shares across all of the exchanges. But you've seen some major volatility, right? I mean, July was the biggest monthly rally in the S&P in a year. August was the worst August plunge in 9 years. Even with the thin trading, how are you guys doing down there on the floor? I mean, is it all right with this kind of volatility?
Well, that's why a lot of traders are standing to the side right now, because we're trading basically between 10.5 and 11.5 in the S&Ps, and the market's just jumping around inside there. So it's a very valid question. After getting beat up inside, that 100-point spread right there, people are just kind of standing back, and they don't want to really get involved in the market right now. We have to break either side of that right now.
Hey, Doug, it's Dominic here. One of the things, if you're talking about this range-bound environment, what's going to get traders to come back in? Is it just the holidays? Are they going to come back next week after the Labor Day holiday? Is it going to be a situation where if it remains range-bound, people just don't trade, or they try to come in only where the tops and bottoms occur?
Well, I think after trading in this range for so long, this 100-point range for so long, obviously the market right now is a little bit lower. We were trading between 1,100 and 11.5 before quite consistently. Breaking 1,100 was tough. To answer your question, I would think that after this week, this is a slow week for us down here. Next week, we'll get more traders in the crowd, and I would think that we would test either side of that. I'm guessing to the downside. Once again, not trying to be pessimistic, but this number today, yeah, it's nice. Everyone hopes it could sustain, but I don't think anyone's really buying it.
I'm assuming you're buying what Doug just had to say, Lincoln, that we're going to start testing to the downside here.
Yeah, I mean, look, you're going to have Charles Biederman on in a little while, and the classic hedge fund trade and a classic positioning trade would be to be long on the 30th and 31st of equities, expecting fund flows at the beginning of the month. This is a very traditional type of move. People do this all the time. I think what's interesting was actually what Zara was talking about in terms of the Dow Industrials. We think that industrials will be the leader in this kind of slowed down manufacturing piece, and the worst performer was, in fact, the consumer piece of the Dow Industrials, Procter & Gamble. And that continues to signal traders and investors alike trying to reevaluate the kind of new normal, as our friends at PIMCO say. But I think this is not a new normal at all, but a totally different environment in which we are going to be investing in and trading in going into 2011 and 2012, where we're going to face state and local budget shortfalls, and we've got a whole bunch of headwinds that we haven't even begun to grasp or grapple with.
Lincoln, Carol mentioned at the top here that you think that rates going up would be not necessarily a bad thing. But I mean, how is it, especially if you've got all of these state and local governments and everybody else grappling with budget problems? How is higher rates then a good thing?
Right. So the point that I've tried to make in a couple of different places here is that higher rates on the short end would collapse the spread trade that most of the large banks and the proprietary trading units have used to lever up their balance sheets and then recapitalize via trading profits. It's interesting to me that today Jamie Dimon says that they're going to actually disband their proprietary trading activities and actually focus more on what we've actually recapitalized these banks to do, and that is to lend. If you don't collapse that spread at the short end of the yield curve, and instead you compress it down at the long end, like Chairman Bernanke's doing, you're just fighting the deflationary tendency that is already out there and being priced into the market. And until you get M2 money supply actually getting its multiplier effect out into the economy, you will have very little to no growth in the real economy, and you'll have no growth where it really matters in the U.S., and that is in the job market.
Lincoln, you know, we've seen and comments from the Fed show that not a lot of people expect a heck of a lot of results from anything that they do there. So what do you think about Christina Romer coming out and saying that she thinks we need more stimulus? You know, she wanted a lot more stimulus to begin with than $800 billion. What do you think Washington can do to improve the labor market, to improve the economic situation?
Well, it's interesting to see Washington responding to Martin Wolf's comments about the Obama presidency having been lost in the first month and really missing the target in terms of this massive stimulus that was called for back in February of 2009. If the government's going to be involved at all, they need to be very involved and laser focused on the job market and the job market only. If you continue to stimulate via trying to get consumers to spend again, it's simply not going to happen. We've seen it time and time again. Both consumers as well as state and local governments are way over levered, and we are in maybe the second inning of that deleveraging process. Focus on jobs if you're going to focus on anything at all.
Well, and that's a good point. You know, Mark Grand of Southwest Securities writes Matt and me pretty regularly, and he talks about, he calls it a wake-up call about the capital of Pennsylvania, Harrisburg, defaulting on their municipal debt. I mean, we all can't forget. I know, you know, Don, we talk about this.
Yeah, exactly right. And here's the thing. We talk about this idea that jobs are the crux for this whole thing. And Carol, Doug, I mean, here's the question. What are people expecting about the jobs number, right? I mean, the jobs number is coming out on Friday here, and we've got all these bad problems with the municipal market. Are traders expecting, what's going to get them to kind of get out of bed in the morning?
Friday, I think we need something positive finally out of the unemployment numbers. But I think the bigger thing that I focus on down here, and I'm not trying to tell anybody else what to do, the banks have to ease lending. If people can't get money to get loans to buy houses, this isn't going to change. The unemployment number is going to stay up there. I think the bigger focus should be on lending, letting the banks loosen up a little bit and let some money out there, because it is almost impossible to get a loan right now.
Lincoln, do you have do you have any?
I just wanted to say that ourselves at Strategic Financial, along with the New America Foundation, have just begun to look at the effects of state and local government budget shortfalls on both GDP and employment, and they are significant for the balance of 2010, 11, and 12. A drag on GDP probably as much as 50 basis points, and a drop of some 2 million jobs at the state and local level. It's a very significant problem.
All right, Matt and I are like scrambling here. Doug, we got a few seconds here left. I mean, we got the jobs report on Friday. We've had a lot of economic news. I'm just curious what you guys are setting up for. Are you setting up for a disappointment? What are you kind of starting to hear already?
I'm guessing. What I'm hearing down here is going into Friday, I think consensus is the numbers aren't going to be good. I don't know. I would think some of this rally is going to evaporate by Friday, and I would think going in there, if the numbers aren't good, you're going to see a reversal in the market again.
Make for happy Labor Day, I guess.
Lincoln, 5 seconds left.
Happy holiday.
What do you expect for interest rates, Lincoln? What's your target? 3.
Looks like it's going to be 0
1.
for a long time.